Haiku, sing.
Once was a ship that Once was a ship that put to sea. The name of the ship was a Billy of Tea. The winds blew up her bow, dipped down below, my Billy boys blow. Soon may the wellerman come to bring us sugar and tea and rum. One day when the tonguing is done, we'll take our leave and go. Soon may the wellerman come to bring us sugar and tea and rum. One day when the tonguing is done, we'll take our leave and go. She had not been 2 weeks from shore when down on her a right whale bore. The captain called all hands and swore he'd take that whale in tow. Soon may the wellerman come to bring us sugar and tea and
I know what happened here. Bruh. Something's wrong. I don't know what, but something's wrong. Does it work now? Hey, look at this. It's working now. Why is that? So there's a new decoration on my back. How about that? This should be maybe like this. There you go. And ta-da! Alright, alright, almighty. So alright. So put this one here. First of all, I remove yesterday socks. Yesterday went down, but today is reversing up. It looks interesting, but I'm not gonna go in unless it pulls back up. And if it doesn't, I will just dismiss the trade. It's $6. I have $6 over here, and here until here is $3. The issue is that if it if it does so, you know what will happen? If it pulls back up here, it would be half of its ATR. It would be half of its ATR, so it will be half of its ATR, and I don't like to go in with a huge big opening candle. So this stock automatically is removed from my watch list for today. Hold on.
Haiku, sing! Haiku, sing!
the last time that this dude, I mean JPM, he wanted to talk and he gave a speech or something. I max lost daily. So what do you think? She should keep going on. Let me open the window. The drapes are closed. I don't know, man. I've got some emails. ATM, everything is red, except Lee. Meta yesterday washed up heavy, huh? Yesterday washed up heavy. MUR, the only thing is that I'm not gonna be able to trade the open. Let me check some. What if I put the camera? Alright, so let's see which emails I've got. I don't think I'm going to trade the open today. JP is going to give a speech. Scary. Food. Meta. If meta pulls up from here, Nvidia coming in strong, but it's gapping down. Meta. Alright, WFC looks good, but the issue is that we are stuck in the range. Cancel. C. XOM, the same, stuck in the range, stuck in the range. Unfortunately not. Nvidia, if Nvidia closes here, now Meta, I cannot go Meta neither. $0.18 of spread. Look at the spread. Get to 66 and let's go, baby. Yeah. Oh man, look at the size. 34, 35, 40. Right. Uncle JP to go to give testimony.
ours to meet. On the eve of the pandemic, the U.S. economy was enjoying its 11th year of expansion, the longest on record. Unemployment was at 50-year lows, and the economic benefits were reaching those most on the margins. No obvious financial or economic imbalances threatened the ongoing expansion. But this attractive picture turned virtually overnight as the virus swept across the globe. The initial contraction was the fastest and deepest on record, but the pain could have been much worse. As the pandemic arrived, our immediate challenge was to stave off a full-scale depression, which would require swift and strong policy actions from across government. Congress provided by far the fastest and largest response to any post-war economic downturn. At the Fed, we used the full range of policy tools at our disposal. We moved quickly to restore vital flows of credit to households, communities, and businesses, and to stabilize the financial system. These collective policy actions, the development and availability of vaccines, and American resilience worked in concert, first to cushion the pandemic's economic blows, and then to spark a historically strong recovery. Today, the economy is expanding at its fastest pace in many years, and the labor market is again strong. As always, challenges remain. Both the individual shutdown and the subsequent reopening of the economy were without precedent. The economy has rapidly gained strength despite the ongoing pandemic, giving rise to persistent supply and demand imbalances and bottlenecks, and to elevated inflation. We know that high inflation exacts a toll, particularly for those less able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to achieving our statutory goals of maximum employment and price stability. We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We can begin to see that the post-pandemic economy is likely to be different in some respects, and the pursuit of our goals will need to take those differences into account. To that end, monetary policy must take a broad and forward-looking view, keeping pace with an ever-evolving economy. Over the past 4 years, my colleagues and I have continued the work of our predecessors to ensure a strong and resilient financial system. We increased capital and liquidity requirements for the largest banks, and currently capital and liquidity levels at our largest, most systemically important banks are at multi-decade highs. We worked to improve the public's access to instant payments, intensified our focus and supervisory efforts on evolving threats such as climate change and cyber attacks, and expanded our analysis and monitoring of financial stability. We will remain vigilant about new and emerging threats. We also updated our monetary policy framework, drawing on insights from people and communities across the country to reflect the challenges of conducting policy in an era of persistently low interest rates. Congress has assigned the Federal Reserve important goals and has given us considerable independence in using our tools to achieve them. In our democratic system, that independence comes with responsibility of transparency and clear communication to keep the public informed and enable effective legislative oversight. That duty takes on even greater significance when the Fed must take extraordinary actions in times of crisis. In order to
God-filled on spy.
Transparency and to earn your trust and that of the American people, I have made it a priority to meet regularly and frequently with you and your elected colleagues, and I commit to continuing that practice if I'm confirmed to another term. The Federal Reserve works for all Americans. We know our decisions matter to every person, family, business, and community across the country. I am committed to making those decisions with objectivity, integrity, and impartiality, based on the best available evidence and in the long-standing tradition of monetary policy independence. That pledge lies at the heart of the Fed's mission and is one we all make when we answer the call to public service. I make it here again with force and without reservation. Everything we do at the Federal Reserve is in pursuit of the goals set for us by Congress. I'm honored to have worked in service to those ends since I joined the Fed in 2012 and as chair for the past 4 years. Thank you. I look forward to your questions.
Thank you, Chair Powell. Many
Many working Americans are concerned about rising prices, and I think President Biden's decision to renominate you to a second term as chair shows he's confident you'll continue to lead our economy through this ongoing crisis. In November, you indicated that the rise of the Omicron variant, 586,000 new cases daily over the last week, that the rise of the Omicron variant posed significant risks to employment and economic activity. Do you agree that higher prices are related to the supply and demand imbalances that can be traced directly back to the pandemic and the reopening of the economy?
Now he
Yes,
answering
yes, I do.
questions.
For the most part, if you look back, and you can trace two developments, including strong
see if we
demand
get
and
a
also
break out of
supply
this.
constraints.
Thank you. Last year, FSOC released its report on climate-related financial risk, which describes how climate change is a threat to our financial stability. In the past, you've said, your words, climate change is an emerging risk to financial institutions, the financial system, and the economy, end quote. Will Chair Powell, will the Fed follow the FSOC report's recommendations, including implementing climate stress tests for the biggest banks?
We are looking at climate stress tests. I think it's very likely that climate stress scenarios, as we like to call them, will be a key tool going forward. I would stress that those are very different from the regular stress tests, which affect capital. Scenarios at this stage are really about assuring that the large financial institutions understand all of the risks that they're
I don't want to be in trades
taking,
while
including
JPM is
the risks
talking.
that may be inherent in their business model regarding climate change over time.
Will you make this a top priority if confirmed to another term?
Yes, it will be. I would say within supervision, as I mentioned, that is likely to be a very important priority over the coming years.
The position of Vice Chair of Supervision, but also yours?
Yes.
It's the Fed's responsibility, as you know, to promote financial stability. It means we need strong financial safeguards in place to protect American workers and families from risks in our financial system. It's all that. Chair Powell, recently the Fed has refocused its full employment objectives to make sure it includes workers of all backgrounds. Do you agree that when all workers, including women, including black and brown workers, are able to fully participate in the workforce, that our economy grows? And do you think it's important for the Fed to understand and proactively address racial and gender disparities in wealth and income and employment in our country?
So what we saw at the end of the last longest in our history expansion was that as the labor market tightened, the benefits began to go more broadly to those at the lower end of the income spectrum and to groups that have been more marginalized from an economic standpoint. And that was seen, I think, very broadly as a highly desirable set of outcomes. So our tools do not generally have direct distributional effects, but I do think that we see now the great benefits that a strong labor market can bring to, right across the whole population and for the whole economy.
But you are suggesting from your answer that only when there is strong demand for labor do people who are more on the margins of society, people of color, women, people who have not done as well, only then will they benefit? Does the Fed have responsibility beyond that?
Well, of course, we have responsibilities in bank supervision and community affairs and fair lending and things like that. But just focusing on monetary policy, our principal tool is interest rates, and they affect demand over time. And I do think the main thing that we can do is to make sure that, consistent with the inflation side of our mandate, that we do foster a strong employment market.
Is part of that a more diverse workforce at the Fed?
As you know, we work very hard to achieve diversity, and as all major American institutions, public and private, do these days, we certainly do. And we think that having a diverse workforce it makes us better at doing our jobs, and so it's an important focus and a high priority.
Okay, thank you, Senator Toomey.
Thank you, Mr. Chairman. Chairman Powell, we all noted with great interest the shift in the Fed's focus, the acceleration of the tapering, and the indication that FOMC members expect now a series of interest rate increases this year. I'm trying to understand where this leads to, and I wonder if you could comment on
the fear in market.
the fact that if we had 3 or even 4 25 basis point increases in overnight rates, we would still, in my view, have a very accommodative stance with negative real short-term rates. Is it your view that it's realistic to bring inflation back to the target level if short-term interest rates are negative, real rates?
So the way I would look at it is this. What we have now is a mismatch between demand and supply. We have very strong demand in areas where supply is constrained, particularly around goods, particularly around things like cars. So we have to, how are those two things going to get into better into alignment? Well, part of the answer is going to be through shifts in demand, and we think that part of it will be through the return of greater supply. So I don't think we look to get all of the realignment between demand and supply through the demand channel, although we should get some. But at the same time, we do think we'll get, over the course of this year, return to normal supply conditions, and that's going to affect our policy. I will say, though, if we see inflation persisting at high levels longer than expected, then we will, if we have to raise interest rates more over time, we will. We will use our tools to get inflation back, and the main reason is this, that to get the kind of very strong labor market we want with high participation, it's going to take a long expansion. We can see that participation is moving only very slowly, and to get a long expansion, we're going to need price stability. And so in a way, high inflation is a severe threat to the achievement of maximum employment and to achieving a long expansion that can give us that.
I think that's a very important point. Let me also just ask you, as I mentioned, I understood the need for quantitative easing, the extraordinary measures that we're taking during the crisis, but I worry that the Fed's decision to continue to use these policies well after the crisis had passed, and in fact we're in the midst of a strong recovery, increases the risk of normalizing behavior like this bond buying. So I think it's your view that it's important that this not become normal routine part of Fed behavior. But could you clarify that? And if it is important that this not become a routine matter, how do we ensure that it doesn't?
So I guess I would start by saying that the last two downturns there's been nothing normal about them. They've been two historically large downturns, one being the global financial crisis and one being the pandemic, and we were called to invent new tools and use all of our tools. If we had a regular way recession, a couple of quarters of negative growth, a typical recession, then the question would be, what do we need to do? And so in this era of very low interest rates, there's not going to be as much room to cut, but that would be the first thing that we would do. Now, just because we have been and probably remain in an era of very low interest rates, we would have to look at asset purchases as the next tool in line, but I don't think we'd automatically use it unless it was necessary.
I would certainly hope we wouldn't automatically use it. I would hope that there would be a very, very high threshold to get over, especially when you consider the ways in which it distorts the allocation of capital. As I mentioned in my opening remarks, one of the things I'm very concerned about is especially the regional banks having strayed from the Fed's statutory mission on monetary policy into inappropriate and overtly political advocacy. Just one of many, many examples, the Boston Fed conducted a virtual event as part of its Racism and the Economy series, in which the speakers routinely and adamantly called for defunding the police. Just nothing to do with the Fed's mandate. For 7 months now, I've been asking for information from several regional banks about their political activism, and for 7 months they have simply refused to comply with my request. So I've requested some documentation from the main Fed with respect to this activity, all of which, by the way, is subject to FOIA in any case. Now, I'm sure it's not your opinion that the ranking member of the Senate Banking Committee is entitled to less information than a member of the general public would get through a FOIA request. So can you commit to getting me the information that is now long overdue?
So I am aware that you have submitted a FOIA request and we're processing it now, and I don't know what's asked for. I don't know whether it's actually covered by FOIA, but to the extent that it is, you'll of course get it.
I think it's very important that this committee and Congress understand how the Fed reaches decisions to engage in political advocacy. Thank you, Mr. Chairman.
Senator Toomey. Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. And Chairman Powell, congratulations on your renomination. I believe that President Biden has made two excellent choices, yourself and Governor Bernard. I think you worked together hand in hand for many years. I think you'll be a superb team, and so I look forward to supporting your nomination and Governor Bernard's nomination also for vice chair. And let me join my colleagues in commending you for an exceptional job with respect to the pandemic. One of the interesting consequences of the pandemic and the employment market is that we've seen wages rise. In fact, we've seen them rise with respect to factory workers and non-supervisory personnel, about 5.8%. And my concern is, would an increase in interest rates in anywhere begin to slow down that rise or indeed reverse it?
So like you, and I think like everyone, we think wages moving up is generally a good thing. But if you look back through history, there are times when wages have moved up in a way that has fostered persistent inflation, and that hurts everyone. It particularly hurts people on fixed incomes. So we don't see that right now, but we do see these are the biggest wage increases in decades, and so we're watching carefully. And you know, to the extent we are looking at this year, what we see is an economy where the labor market is recovering incredibly rapidly, really beginning around the end of the middle of last year. The unemployment rate's been dropping at more than 0.3% per month since last June. It's now below 4%, which is pretty close to half century lows. So that part of the employment market is doing very well. Meanwhile, inflation is running very well, very far above our target. And what that's telling us is that the economy no longer needs or wants the very highly accommodative policies that we've had in place to deal with the pandemic and the aftermath. So that's what that's really about. We're really just going to be moving over the course of this year to a policy that is closer to normal, but it's a long road to normal from where we are. Right now we are very highly accommodative, and it is really time for us to begin to move away from those emergency pandemic settings to a more normal level. It really should not have negative effects on the employment market.
Which it's ironic because, as you pointed out in your opening statement, when you took over, we had 11 straight years of significant economic growth, but that was not translated into the wages of most working people, particularly entry-level and non-factory workers, et cetera. And now we've seen a situation where that's reversed, and I would hope that we could continue that type of progress. And I know you'll be sensitive to that going forward. One of the interesting things about the situation we face now is that the Fed tools are probably most effective reducing overall demand. But a lot of what we're facing is supply problems. You know, the situation about automobiles, the problem there, in fact, I think used cars are so expensive, they're distorting the inflation numbers significantly. And that's a result of a shortage of microchips and other types of chips, which is a result of the pandemic. These are supply issues. So to what extent will your dealing with demand help supply? Or maybe that's the real problem.
No, it really won't. We really can't directly affect supply side conditions, and that's why I mentioned this really is a problem both of very strong elevated demand, particularly in a part of the economy, the goods sector, the durable goods sector, things like washing machines and cars and all of the things that people bought during the course of the pandemic when they couldn't spend money on travel and services. That's where spending is running at a level 20% above where it was before the pandemic, and it's just kind of overwhelmed the supply chains, most of which are global in these days. You're getting parts and fully assembled products coming in. So we can affect the demand side. We can't affect the supply side, but this really is a combination of the two.
Well, a final point I want to make is that the issue of climate change is absolutely critical. It's an economic issue.
To begin with the questions that I had prepared for you,
I
wanted to ask you about a statement that former President Trump issued, which I received just
but if you look
prior
at
to the
any
hearing. Have you had a chance to review that
could be
statement?
the case.
My counsel called from Arizona and read it to me.
View this as an economic issue.
In that statement, I
and
won't read
pursue
it in its
as an
entirety.
economic issue that's
Former
gonna
President
affect
Trump
us, dramatically.
begins by calling you a rhino,
my colleagues in our White
Republican
House
name
has been
only.
one of the most staunch
He then
visionaries
references
advocates
a
for that position,
conversation
and I hope the Fed
in
is
November
responsive.
2020
Thank you, Mr. Chairman.
in which he claims that you told him that the election was rigged,
Thank you,
that
Mr.
he had won
Chairman.
Arizona.
Chairman Powell,
To
welcome
quote
back
the
to
former
committee. You
president,
spent a
during
long
the
time with us
conversation,
in the
you
past.
told me the election was rigged and that I won
Inflation is
Arizona.
currently surging
unquote.
at its highest rate in 40 years.
Did you have such a
And
conversation
while
with
I
the president?
appreciate the decision
I did have a
the Fed
conversation with the president.
made to begin tapering, I'm concerned
that
that
certainly
the Fed
isn't it.
missed the boat
But
on addressing
there were
inflation.
parts of it
sooner.
that
A
are
lot
true.
of us are. And as a
parts that are
result
not
of
true.
that, the
And
Fed
the part
under
that I
your
read you,
leadership has lost a
is
lot
that
of
false?
credibility.
Anywhere, anyone,
have a little
anytime
time, so I have
that
a
said
number
that
of
I said
questions,
the
and I
election
know
was
you
rigged,
probably remember
that would not be
maybe
true.
Together we'll remember them all. But I'd like
And
to touch
when
on this, if you
the
would.
former
I'd like
president
for
in
you
his
to.
statement today
Why did the
claimed
Federal Reserve initially
that you told him that he
forecast
won
inflation
Arizona.
to
Is
be
that also
transitory?
false?
That is
Secondly,
also false.
has your view on the threat of inflation changed? Why? What assurances can you provide here today that the Fed has a better grasp today on inflation than a year ago and so forth? And what factors have caused the U.S. to have greater increases in inflation compared to other developed countries? And I guess lastly, yes, how important is price stability to the American people? And that's a lot of questions, but these are all relevant to your job. Thank you.
Respecting your time, let me go right through these. First, let me say price stability is half of our mandate. There's no basis in the law for preferring maximum employment over price stability or vice versa. They're equal. However, at different times, one of them is farther away from its goal, and that's the one we need to focus on a little bit more. Sometimes that's maximum employment, sometimes it's inflation. I'd say now it's inflation. So on inflation, why do we say transitory? We said that because we thought that these supply side bottlenecks and shortages would be alleviated much more quickly than they have been. There's no empirical experience with this before. We haven't had the global supply chain collapse. We haven't had this kind of a labor force shock before. So we and essentially all other mainstream forecasters forecasted that by now we'd be seeing much lower inflation, and that's not what happened. So what's changed is that, just as I mentioned, the supply side constraints have been very persistent and very durable. We're not seeing really a lot of progress. If you look across, the global supply chains and what's happening domestically, look at our ports, look at Long Beach and LA, the two big ports on the West Coast for Asia. The number of ships at anchor is still at a record level. So we're not really seeing yet the kind of progress we essentially all forecasters really thought we'd be seeing by now, and that's really what's driving it. I think we did foresee the strong spike in demand. We didn't know that it would be so focused on goods, but so that's really what happened. And so I think we learned that it wasn't that it was just this is a unique set of circumstances. We haven't had really the United States economy is so dynamic. The supply side adapts quickly. And, there are new companies being started and old companies dying all the time. This is a situation where there actually are hard constraints people want to buy cars. Car makers can't make any more cars because there are no semiconductors. So that's never happened. I can't think of another example of that, and that's true across. So what factors really? It's the supply side. Did I miss any? I like to think I covered, at least touched all 5 of those.
What have you really learned and you would share with your fellow Board of Governors to get a grasp as much as you can on inflation? Because a lot of us have been on the committee a while, and we remembered what Dr. Volcker did with the Fed under his leadership, and it was draconian, but it worked. I hope we won't have to do that, but you've got to do whatever you have to do. Do you agree?
We have to achieve price stability, and I believe we will, and I'm confident we will. And again, it's not just a question of restraining demand, although that will be. Right now, we're stimulating demand with very highly accommodative policy. As we move through this year, we will, in all likelihood, we don't know the future, but if things develop as expected, we'll be normalizing policy, meaning we're going to end our asset purchases in March, meaning we'll be raising rates over the course of the year. At some point, perhaps later this year, we will start to allow the balance sheet to run off. And that's just the road to normalizing policy. That's what we're going to be doing. Of course, we're committed. But we also we do believe, and I think widely it is believed that these supply blockages will be alleviated too, so that there will be more supply as well, more labor force. But people will be coming back into the labor force. We'll see more recovery, although it's been slow from participation. And we'll see these global supply blockages coming down. We'll see some more cars, although that's going to take some time. And that will help as well, getting supply and demand back at the same level.
Senator Menendez from New Jersey is recognized.
Thank you, Mr. Chairman. Chair Powell, let me start by reiterating a point that I've made, unfortunately, far too many times. And the latest batch of nominees leads me to, once again, the conclusion that there is a serious diversity problem at the Federal Reserve. Latinos are the country's largest minority. They make up nearly 20% of the entire U.S. population. It's outrageous that they have no representation in Fed leadership. There's never been a single member of the Board of Governors or regional bank president that has lived the experience of being a Latino in the United States. And that means that the voices of 1/5 of the country's citizens are repeatedly drowned out when the Fed is making critical decisions on economic policy, decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. In late October, several of my colleagues and I sent you a letter requesting that you work closely with the Boston and Dallas banks to recruit diverse candidates for their open president positions. We received your response to that letter just last week, and I have to be honest with you, the lack of detail was thoroughly disappointing. I'd be expecting you to provide a more detailed update on the search process before your confirmation vote, including what specific changes you've made to the process and how they're going to lead to a more diverse candidate pool, and I hope that you will do that. While we face significant challenges with the Omicron variant and supply chain disruptions that are both causing families to face higher prices for a variety of goods, the fact is that we're experiencing a strong recovery from an unprecedented pandemic. Thanks to the American Rescue Plan and other policies put in place by Congress and the Biden administration, we gained an average of 537,000 jobs per month since President Biden took office. So, Chairman Powell, if you're confirmed, how would you continue to balance the Fed's dual mandate to keep price increases manageable while not dampening the strong job and wage growth that we've seen over the past year?
So by so many measures, labor demand relative to supply is at its highest level, really, that I can remember. The level of job openings is at an all-time high as a percentage of the labor force. The level of quits labor economists look at the level of quits as a real indicator of how strong the labor market. The percentage of quits, the number of quits, is at an all-time high. So the problem is not lack of demand for labor. The problem is that there's a significant supply problem, which is associated with the pandemic and a range of other factors. Participation has not recovered, but as you can see, for people who are in the labor force, the unemployment rate is dropping at historically fast levels. So we don't have a labor demand problem to solve through our policy. What we have is a labor supply problem. So what is the threat? We're clearly on a path to have an even better labor market over time. What are the big threats to our getting there? Well, I would say very near the top of the list is the threat of price stability. If inflation does become too persistent, if these high levels of inflation get entrenched in our economy and in people's thinking, then inevitably that will lead to much tighter monetary policy from us, and it could lead to a recession. And that will be bad for workers. So really, achievement of maximum employment, by which we really mean continued progress in hiring and in participation, is going to require price stability, and that's going to require us to use our tools to the extent they work on the demand side, while we also expect some help from the supply side.
Do you expect inflation to subside as vaccinations increase and supply chains are repaired?
Over time, yes. Over time. The question is how fast, and the risks that we're running in the meantime that inflation psychology starts to get entrenched. But certainly I believe that. And you make a great point about vaccination. Getting ahead of the pandemic, I mean, I don't think 2 years ago we thought we'd still be having record levels of cases and even close to record levels of hospitalizations. Getting past the pandemic is the single most important thing we can do.
Now, finally, according to the New York Times, New Jersey and other parts of the Northeast were hit particularly hard at the beginning of the pandemic and during the most recent surge, while the Midwest was most strongly affected in November of 2020 and the South at the end of last summer. How closely does the Fed look at differences in regional performance when making policy decisions?
We have to focus on the national level, but of course we follow, in this instance, the earlier Delta, for example, COVID rolled around the country on a regional basis. That's not so much the case with Omicron. It's so contagious, and it's not the same everywhere, but it really is going through the whole country at a pretty rapid rate. But we follow that very, very carefully. You know, I would say we didn't know much about vaccines and pandemics 2 years ago, but we've all had 2 years to learn. So, but we defer to the experts, though. We don't substitute our judgment on medical issues for the experts, but we talk to them all the time.
All right. Well, I look forward to following up with you on the diversity question. Thank you, Mr.
Senator Crapo is recognized from Idaho from his office, I believe.
Yes, thank you, Mr. Chair. And Chair Powell, welcome back to the committee. When you last appeared before the committee, I also asked you about an expected Fed report on digital currencies. You indicated that delays in releasing the report were because the Fed wanted to ensure that their analysis was correct and to complete and that a release was expected in the coming weeks. However, that report still has not been released. Do you have an update you can share on the status of the report? And are there problems with sharing this report with Congress and the public and what the Fed may be proposing with respect to possibly centralizing public digital currency?
So the report really is ready to go, and I would expect we will drop it. I hate to say it again, in coming weeks, but it really is in a situation where it's ready to go. The fall for us, given changes in monetary policy and other things going on, it was hard we didn't get it quite to where we needed to get it, but it's effectively there now, and I will tell you, it's within weeks we will be publishing it. And by the way, it's more going to be an exercise in asking questions and seeking input from the public, rather than taking a lot of positions on various issues, although we do take some positions.
All right, thank you. Well, as I hope that you'll be able to meet this
Got-filled on AMD.
Weeks projection. As you know, I've been asking you and the other members of the Fed about this for a long time, and I really do believe it's time that the Fed release this report so that we can engage in the further discussion of it. I want to also, with the rest of my time, go back to the issue of inflation. I know you've talked about it a lot with us this morning. In response to my questioning about inflation last November, you confirmed that inflationary pressures would certainly last, and you're through the middle of
got filled on AMD
this year, this coming year. What do you now expect with the economy we've seen since you last answered these questions in front of the committee? What do you now expect inflationary pressures to look like throughout this year?
I wouldn't say things have changed much on that front since last November. I think that inflationary pressures do seem to be on track to last well into the middle of next year. And if they last longer than that, then I'll just say that our policy will continue to adapt. Our policy has been adapting to this, for some months. But if inflation is going to last longer, then that would potentially imply more risk of its persistence and ultimately becoming entrenched, and our policy will respond accordingly.
You just said well into the middle of next year. Did you mean this year or through all year and then next year?
I meant this year. You're right. I still think it's 2021 sometimes.
Hey, I thought so, but I wanted to be sure what you were saying. With regard to the question of what's going to happen over the next 3 to 4 months, as we try to deal with the inflationary pressures you've described, if consumer price inflation were to persist over the next 3 or 4 months at somewhere between 5 and 7%, as we are now seeing, and if the unemployment rate were to remain about where it is now, below 4%, what would you expect the tools that the Fed would need to use would be? And I noted in one of your responses on the inflation issue earlier today, I thought I heard you say that the Fed's overnight interest rate would still, even after you may use it as a tool, would still be very low. Could you just discuss I know you can't predict with specificity what the Fed would do, but could you discuss what you expect interest rates to look like as you utilize that tool?
Sure. So I think to your point, we're at a place where unemployment is now very low, historically low, and
got filled on AMD.
Target, and the economy no longer needs this very highly accommodative stance of policy. And I would expect that this year, 2022, will be a year in which we take steps toward normalization. That will involve raising the federal funds rate. That will involve ending asset purchases in March. And perhaps later this year, depending on the run of things, we would also see ourselves beginning to allow the balance sheet to shrink. So that's what I think that's the broad picture of what I see happening. The committee hasn't made any decisions about the timing of any of that, and I think we're going to have to be both humble and a bit nimble here. If you go back and look at where we were a year ago today in the economy, vaccines were arriving. I think that in my thinking there was the idea that'll really help us get past the pandemic, and it has helped a lot, but yet we're at all-time record cases and approaching record hospitalizations nationally. So the thing has stayed with us longer, and I think we're going to have to be open to the changing environment, and monetary policy is going to have to adapt as we learn more. And then we're going to learn a lot about the path of inflation, particularly as it relates to these supply-side blockages we've had over the course of the first 6 months of the year and every month, really.
So do I understand, are you saying that if the pandemic remains problematic and aggressive, that would impact the timing of any decisions the Fed might make in terms of the federal funds rate?
So I'd say it could, but what's happened is the economy has made all these gains in the face of
filled on AMD.
2021, we had 2 major pandemic outbreaks, 2 variant outbreaks, and really the beginning of 21 was dominated by a very strong wave of the original COVID. So, and yet the economy, we made tremendous progress in the labor market in 2021, and growth is at a multi-decade high in 2021. So I expect the economy to continue to be able to deal with these with these outbreaks. I think it is likely, though, if the experts are right and Omicron is going to go through really quickly and peak perhaps within a month and then come down after that, I think it's likely you will see
if
lower
we get a
hiring
25 break
and
at
perhaps a
25.
pause in growth and that kind of thing. But it should be
I don't know.
short-lived. It should be, and then the economy, the forecast for the rest of the year, or certainly for the next quarter or two, would be a very positive one. Very positive.
And if that happened, would that increase the likelihood of Fed action to increase the federal funds rate, or would it?
One more minute left
Yeah.
into the candle. It's one of those.
If that all happens, I think what we're seeing is an economy that functions right through these waves of COVID, and my colleagues and I see that, and you see that every quarter we write down projections of interest rates. They're individual projections. They're not a committee plan or anything like that. But broadly speaking, all members of the committee see interest rate increases coming this year. The median was 3. But that's going to depend on data. It's going to depend on the progress we see on the supply side, the progress we see on inflation.
Pull and go, bro.
And we honestly don't know. There's risk on both sides, really, on growth and potentially on inflation as well. So we're going to have to be just very attentive to what's happening in the economy and willing to adapt pretty nimbly our policy as we go through the year.
Thank you, Senator Crapo. Senator Tester from Montana is recognized.
Yeah, thank you, Mr. Chairman. I don't know if there's any way to turn that mic down, but that was almost painful. I mean, it was tough. Not your questions, Crapo, just the intensity. First of all, Chairman Powell, I want to thank you for your willingness to serve. I appreciate your work that you've done working with the Federal Reserve Board throughout the health and economic crisis that we found ourselves in. And just to say, as many have said before me, we appreciate your steady hand. In your opening statement, you talked about climate change and cyber attacks, taking those into account as part of the things the Fed has to do. There was an interesting story in the Post yesterday that talked about $145 billion this country spent on disasters in 2021. December was the warmest ever, and last year was the fourth warmest year.
Got filled on AMD.
And I think that's a conservative number because I don't think it took in the impacts of our crops and crop insurance and things like that. I say that because I hope you will continue to gather as much information as possible about what needs to happen as this climate situation appears to be getting worse and not better as time moves on. The American taxpayer deserves that.
Let's see what JD can deliver
look,
now.
The challenges that we've had because of this pandemic, it's fair to say that the Federal Reserve has helped us get through this in a major way. This question's been asked before, but I'm going to ask it again in a different way. Could you compare the economy pre-pandemic, pandemic a year ago, and today, and tell me where we're at in relation to those 3 different points?
Alright, it's coming back in now. I said I'll go back in if it pulls back up, and it does. Need R4 to break, honestly.
Got filled on AMD. AMD. Last equals 85.31. Got filled on AMD.
AMD 100 more.
Got filled on AMD.
Again, I'm looking at AMD for a rip. And I'm setting AMD into don't.
Got filled on AMD. Got filled on AMD.
I'm just looking to get out of this negative day and then finish trading today for today. I'm looking at 50 to break. 51 to break. Qs are ripping. Even if it's like a $50 trade, I would be happy.
Got filled on AMD.
Oh, come on.
Got filled on AMD.
I'm looking at 60, and at the same time I'm looking at next $10. It's a go, and not really. Yeah, I'm looking at 75 now. I'm looking at 75. I'm looking at 85, 75. And the breakout to the upside, I might add.
Got filled on NVDA.
I have AMD under watch. Going red, this going red, gonna be painful for me. Although AMD must make its $9 and I'm gonna get out because of this is not correct. What I'm doing is not right with AMD. Alright, so we have, give me 80s ahead. I'm looking at 80 and I'm looking at 86. Yeah. And there could be a hefty pullback.
Got filled on AMD.
Oh.
Got filled on NVDA.
Oh, am I red? Are you serious?
Got filled on NVDA.
Nvidia loss was very unnecessary. Like absolutely no. What happened here? We have 28.49. This is a bust. I didn't think that liquidating this panic will liquidate all of my trades. I wouldn't hit it. I'm at 15. AMD can easily go. SPY Qs are already going, and SPY is at the top, but it has potential to go. So if it doesn't, I have to close this trade at wherever I am. 93. Below 90 is not a good thing for me. But see, there is a pushback to the upside again. It's coming back up again, and we'll see what happens in next 10 seconds. And market, if market can push to the upside, we'll get a drop. We'll see if it's a go now. I got in for unnecessary $12 loss on a Nvidia. Absolutely unnecessary. And the moment, because it was a mistake, the moment that I'm getting it back, I will get out. Although it looks like the Qs are going, SPY is going, and maybe I should get out of this. Below 91 is not a good thing.
Got filled on NVDA.
I got out with loss. I waited too long for this. It became too extended. Oh, Baba. I wanted to go long on Baba, but I forgot to set an alert. So when it pulls back heavy as a hammer, it just made it 2 down. Now when it goes around 97 again, 95 with the stop down here would be a good entry. 50 cent, 200 would be fine. And we have the capability of moving 50 cents every 5 minutes, so we'll see. It was obvious that people are gonna short it at the top. Alright, give me a hammer around 60, 65, 95, sorry. JD as well. JD, I missed on JD as well. Lee as well. Most of the stocks. Oh, this is a good one. Not really. AMC is holding. The level is holding.
Got filled on NVDA.
I have $40 of risk for this thing. I just put it here in case I get disconnected from internet. I'm looking for a BHOD to the upside. $4 my max loss. We'll see now if it pulls back. This could be a bust to the upside, or it becomes a drop.
Got filled on NVDA.
Forget it. This doesn't work. Nvidia doesn't want to give it now. Maybe it needs to drop a little bit more and then pulls back up. SPY is still going. I can't believe SPY is during all of the talk of JP's rallying like this. Maybe it's lack of short sellers, or maybe just people are covering and they are getting out of positions. I don't know.
Got filled on NVDA. Got filled on NVDA.
Let's go NVDA 150. Just a break of HOD will give all back to me.
NVDA. Last equals 166.08.
106 and I'm going to get up. Wow.
Got filled on NVDA.
What?
Got filled on NVDA.
I'm out, bro. This ain't work. Nothing, bro. Nothing. Look, SPY is ripping, huh? SPY is successfully ripping. Q's head dead. That's why no, the thing doesn't work.
Hello. IT?
Something's wrong with my computer.
Have you tried turning it off and on again?
No. Oh dear, thanks.
You're welcome, mate. Hello, IT.
Try turning it off and on again and nothing happens.
Is it definitely plugged in?
Let me have a look. Oh, sorry, that's it. Thanks very much.
You're welcome, mate.
Some of this stuff. But from a rural perspective, is the Fed doing anything in particular that I could take back to my constituents and say, this is what the Fed's doing to help rein in inflation in rural areas?
Well, so we are, of course, well aware. As you know, we have 4 or 5 Reserve Bank presidents who have very large agricultural economies within their districts, and we hear excellent reports from them about what's going on, and it's clearly a tremendously challenging situation. Fertilizer prices and all kinds of inputs, very, very difficult situation. Can't get parts for your equipment and that kind of thing. So, overall, we do appreciate that. You're not seeing this yet, but when if times do get difficult, then we work carefully with borrowers in the Farm Belt and that kind of thing, because we know. That's what you do in those kind of times. We're not at that times at this point, but that's one thing we have done in the past. I mean, overall, we think we need to get back to price stability, and that will help. That will help everybody. Will help the whole economy, including rural America.
Okay, interest rates. I know they've been raised a bit recently. I think 3/4 of a point. Correct me if I'm wrong. And I'm not going to ask you where interest rates need to be. But I do think that there's a fine line to walk, and you tell me if I'm wrong, where if interest rates are raised too high, it could drive us into a recession. Can you tell me some of the things you're looking at to make sure that doesn't happen?
Sure. So when we pivoted and started talking about raising rates last year, markets have priced in, rate increases so that all out of the curve of debt maturities, interest rates have already moved up to reflect interest rate increases that we haven't actually made yet to our. So what we have right now is a low short-term rate, which is our policy rate. So, and the increase that we made one decision at the last meeting, which was to raise by 75 basis points, but only to 1.6%. So, and we thought that was the right thing to do. I'm happy to discuss why. But really, the point is that our policy rate is still at a relatively low level. And in principle, we want to get it up to a more neutral-ish level, even more expeditiously than we had been. And that's what was behind our thinking. And that's really, so the concern, I don't think is about the level, it was with the speed. Are we moving too quickly? And I think I was persuaded that it was important that we make this move now and not wait and telegraph it and do it 6 weeks later, for example, or the meeting after that. It was important to do it now because where we are with inflation is having seen inflation come in above target over and over again, and we said we'd move more aggressively if it was appropriate. We thought it was appropriate, and we did.
So what? And so you said you want to get to things more to a neutral level, and are we to a neutral level now?
No, so we estimate the longer run neutral level of the federal funds rate to be around 2.5%, and actually we think it will be appropriate to raise rates above a neutral level into a modestly restrictive level because this is very high inflation and it's hurting everybody, and we need to do our job and get inflation back on a path down to 2%, and the way we're going to do that,
Do you agree with the perspective that
certainly a possibility. It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events of the last few months around the world have made it more difficult for us to achieve what we want, which is 2% inflation and still a strong labor market.
Thank you, Mr.
Senator Chester. Senator Haggerty of Tennessee is recognized.
Thank you, Chairman Brown. Chairman Powell, one of the many downsides of quantitative easing is the fact that the Federal Reserve, and then by extension the American taxpayers, essentially taking a long position in the securities that are required. That means that when rates rise, the value of the securities on the balance sheet will drop. That's exactly what's happening today. And as of March of this year, the Federal Reserve had about $330 billion worth of unrealized loss on its balance sheet. That number is probably close to $500 billion right now, given the rise in rates. So my question of you is, do these unrealized losses limit the Federal Reserve's ability to execute its monetary policy objectives? And specifically, will the Fed sell mortgage-backed securities and realize a loss? Or will the Fed be cornered into holding the securities until they appreciate?
So those kind of unrealized losses play no role in our decision-making, have no effect at all on our ability to conduct monetary policy. They're just not a consideration. And they won't be a consideration when we decide whether to sell and in what quantity MBS. We said we would look at selling MBS when the normalization process for the balance sheet was well underway. And that means not soon. We haven't decided exactly what that means. When we make that decision, and the reason, by the way, the reason we want to do that is we're committed to having a mostly treasury balance sheet. And with these higher rates, MBS prepayment speeds have gone way down. And so to achieve the mostly treasury balance sheet, we may well need to sell MBS at some future date. When we turn to that, we're going to be very transparent, give lots of transparency about it. But we won't be thinking about the balance sheet. I mean, remember that we've contributed $1 trillion in profits to the treasury over the course of the last 10 years. At least we don't have a lot of capital, but we give our earnings to the treasury. So it's not at all.
But to be clear, the elongated point, Chairman Powell, I realize there are a number of factors that play a role in the historic inflation that we're experiencing. Supply chain disruptions, regulations that constrain supply. We've got rising inflation expectations and excessive fiscal spending. But the problem has been sprung out of nowhere. And in January of 2021, inflation was at 4.8%. By December of 2021, it had risen to 7%. Since the war in Ukraine began in February, the rate of inflation has risen incrementally another 1.6%, to the current level of 8.6%. So again, from 7% to 8.6%. Given how inflation has escalated over the past 18 months, would you say that the war in Ukraine is the primary driver of inflation in America?
Well, inflation was high before, certainly before the war in Ukraine.
I'm glad to hear you say that. The Biden administration seems to be intent on deflecting blame, and as recently as this past Sunday, it spread the misinformation that Putin's invasion of Ukraine is the, quote, biggest single driver of inflation. That is not the case. I'd like to turn to the situation we find ourselves in now. A recent survey of global CEOs showed that more than 60% of executives expect a recession in the next 18 months. Meanwhile, for its most recent forecast, the Fed will be tightening monetary policy for the next 2.5 years. Thus, the Fed could soon find itself in challenging position of exacerbating an economic downturn in order to address the historic inflation that has been by 5.3. So, Mr. Chairman, as you know, the Fed has a dual mandate to apply so much to maximum employment. How do you think about balancing this potential tension between the Fed's two mandates, particularly as the economic outlook worsens, but inflation remains elevated?
So, if you have a dual mandate, right now, the labor market is extremely tight, sustainably hot. There's a mismatch between supply and demand there. As you know, there's more job openings than there are, by a factor of 2 to 1, than there are unemployed people looking for work. On the inflation side, we're very far from our target. So we think that we have to restore price stability, put the economy back in a place where in the long term we can have a sustainable that's how we're thinking about it. Of course, we're not trying to provoke, we don't need to provoke a recession. We do think it's absolutely essential to restore price stability. Really for the benefit of the labor market as much as anything else.
I agree. I think you have an extremely challenging job, particularly given some of the fiscal policies that have been undertaken that make your job more challenging than it should be. Thank you very much, Mr. Chairman.
Senator Smith.
Mr. Chair,
If you look across the numbers of measures that we look at, they're significantly above that. Now, there's some evidence that they're flattening out, particularly average hourly earnings. There's some evidence that that measure of wages is flattening out so that it's no longer going up. So it's really not about reducing wages. It's just having a more sustainable pace of increases.
And what would you expect if wages started to stabilize, as you say, they stop increases? How long would you expect it to be before the prices that consumers are paying would start to go down?
So
are they ever going to go down?
It depends in, prices don't have to go down for inflation to go down. So if prices remain at the same level and inflation goes to zero. But it depends on different businesses. In some service, in parts of the service economy, labor costs are a very large portion of costs, and so you would think that gets passed through very quickly in prices. And so we would think we would think that pass-through should be shown fairly quickly in some parts of the economy, in others less so. But over time, we would want wages to be moving up at the highest sustainable rate that's possible, and consistent with 2% inflation.
And of course, at the same time, the economy got this very, very strong labor market, but simultaneously, we continue to see higher unemployment rates among African Americans, for example, nearly double the unemployment of white Americans. So, how do you see this sort of interplay between wage growth and what the Fed actions to cool demand on that underlying issue?
So we don't target wage growth, of course. Our job is price stability.
Right.
We look at wage growth because over a long period of time, it's an important factor in determining price stability. So that's really how we think about it. In terms of the disparities, we saw those disparities increase significantly at the beginning of the pandemic and then reverse, as we pointed out in our monetary policy report. Those gaps have at least returned to historically lower levels. There's still gaps though, and those are not really gaps that we can get at with monetary policy. But we point them out because they're an important aspect of our economy, and we do consider them as we think about appropriate policy.
I think I would agree with you. I think that those are sort of systemic challenges in our economy that need to be addressed through the policy that we work on here. It seems to me that I think we have a labor supply problem in this country, and we should be dealing with that in Congress in terms of what we need to do to make sure that people have the skills and the capacity